Backdoor Roth IRAs, how you contribute if you're over the income threshold. My name is Tony Cameron with TLDR Accounting, and we provide tax and accounting services to small business owners and therapists in private practice. So if you watched my video about Roth IRAs, I referenced something called a backdoor Roth IRA. So as we talked about, there are income thresholds to be able to contribute to a Roth IRA. For 2021, it's $208,000 if you're married filing jointly, and $140,000 if you're single. That's your AGI. So that includes all of your wage income, interest, dividends, any capital gains or losses, along with any rental income, because it's calculated on your adjusted gross income. Now, if you're over that amount and you still want to contribute, there are ways that you can, and that's called a backdoor Roth IRA. Our general recommendation is if you're going to do one of these that you do it all in the same year. So what happens is you establish a traditional IRA. Maybe you use one of the brokerage accounts that you already have, or if you have a relationship with an investment advisor, and then you contribute $6,000 to it. That's if you're under age 50, or up to $7,000 if you're over age 50. From there, you open up a Roth IRA. Then what happens is you convert that contribution, that $6,000, to a Roth IRA. You do a rollover contribution. Usually you have to talk to your brokerage person who's taking care of it, or if you're doing it directly, you should be able to call customer service and have them walk you through it. We recommend you do that in the same tax year. So say you do this in July each year. You make a $6,000 contribution for your traditional IRA for 2021. Then July 15th, you convert it over to a Roth IRA. You're good to go for 2021. It gets a little bit more complicated if, say, you contribute it in November to the traditional and then convert it in January. So just keep it in the same calendar year, and then you should be good. One thing to keep in mind, though, is if, say, that $6,000 earned $50 in interest or dividends between July 1st and July 15th, you will need to pay tax on that money that you earned between those two dates. But if you're doing it within the same week, or in a close time frame like that, there shouldn't be much. Maybe, it's $1 or so in interest that you need to pay taxes on. But that is how you make a backdoor Roth contribution. As always, one of the things that you want to keep track of is that you're doing it all at once, and that you make that contribution. The other thing is make sure you don't over contribute to your traditional IRA. Sometimes folks are like, oh, I made a backdoor Roth contribution, then I contribute another $6,000 to your traditional. Nope, you contributed your money, you converted it, you're good, right? You only have the set amount for the traditional IRA that you can make, and you can either convert it or leave it in the traditional IRA. We have a lot of folks who ask if it's worth it to go through that. One of the things to keep in mind is even though you converted the funds to a Roth IRA, it still needs to stay in there for 5 years. So it needs to stay in there for 5 years, or you get hit with a penalty. So you don't want to get hit with any of the penalties. A big reason why people do this is because of tax rates, and if they're going to increase, if they're going to decrease, and your personal philosophies on that. We don't know what's going to happen with the tax code. It changes year to year. So if that sounds like something you want to do, it's one of the things that you can do. It does need to be reported on your tax return each year. So it'll be one of the things that your accountant should be asking about, or if you're self-filing, it should be reported on Form 8606. Hopefully you found this helpful. If so, subscribe below.